Hello, founders. Welcome to Startups.com. We are live. We have a bit of an improvised show today as we've got some neat topics that we want to cover. If you are joining us here from Startups.com, appreciate your support always. I'm going to be putting this up multiple times. We are going to answer some questions today, some common burning questions that typically are asked of me, and I collect them from all over the place on my YouTube channel and the different social medias out there. If you have a question, make sure you type it into the Q&A box now. Use that Q&A box or just chatter away in the chat. That's what it's there for. I'm joined by my co-host, Jen, my right arm in terms of all the execution, executive operations here. And she will be watching the chat box and making sure that we answer all the right questions for you. This episode of Startups.com Live was brought to you by us, Startups.com. If you have not checked it out yet, we have a podcast called Startup Therapy. It is hosted by Will Schroeder, our CEO, and Ryan Rattan, our CMO, and they talk about all the topics that founders typically don't talk about: what it's like to be a founder, what it's like to raise capital, exit, the emotional stuff. We've got lots of great topics such as evolution of entry-level workers. Assume everyone will leave in year one. That's a great story. Was mortgaging my life worth it? What's my startup worth in acquisition? All those types of questions that you want to have answered, we are going to answer them here as well. So one more time, if you have a question, think about the question, type your question into the Q&A box. In the meantime, I am just going to just talk about some of the questions that keep coming up and that are asked on my YouTube channel. Question number one is talking about crowdfunding, grants, and options. Let's talk about crowdfunding for everybody who would think about and could be interested. Remember, there are multiple types of crowdfunding. There is equity crowdfunding and there is rewards-based crowdfunding. Equity crowdfunding is when you go out to the crowd and you do a Reg CF, standing for crowdfunding, and you say, I can take investment in for $500 a piece, $200 a piece, and you can raise up to a certain amount from unaccredited investors. What's super important about this is that unaccredited investors, typically, you can't solicit to them. You can solicit to certain types of accredited investors if they are a venture capital fund, angel group. You can solicit them cold, but you can't solicit high net worth individuals unless they say, I'm an accredited investor. And you can't solicit them outside your network and via public means, public solicitation, unless you file the proper regulations and there's compliance and all those things. Why? Because we don't want scams. Because the government doesn't want scams. The SEC, FINRA, all the financial regulatory authorities out there do not want scams to happen. So when, I believe it was Barack Obama, he passed something called the Jobs Act, which allows you to solicit to the general public and use the internet. And that's where sites like Fundable, which we own, formed. And now you got WeFunder, you've got Start Engine, you got all these other companies out there that help with Reg CF and Reg D raises, which is a little bit of a different thing where you're raising from accredited investors. Reg CF is great, but let me tell you, you need to have an audience. You're not just going to put your offering out there and people are just going to magically find you. It's the same thing with rewards-based crowdfunding, which is where you sell your product or service ahead of time and you say for trusting and pre-buying, let's say it costs $100 and you say, all right, I'm going to sell it ahead of time for $50 a piece, and they collect your money for you. You're rewarding them and you're saying thank you very much. And that's a great way to raise money and to prove that you've got validation in the marketplace. But any crowdfunding requires you to have a built-in audience. It can be extremely powerful, and the reason being is that you can have your investors become your raving fans. I have a founder who did a crowdfunding campaign, Reg CF raise, on an AI engine for like news, and he chose crowdfunding, and he's since raised like $2.5 million, probably more. It's been a while since I've connected with him. I should follow up with him. But his investors are raving fans. They want to support everything. That's how that works. That might be advantageous for you, but you have to have that built-in audience. I know a founder who raised a bunch of money, I think 5 figures, not 5 figures, 6 figures of money. Yeah, maybe 5, 6 figures. And the reason he raised that level of money is because he already had a built-in audience. He had a social media channel. Typically speaking, if you're going to do crowdfunding, you want to have 50% of your campaign. This is for equity and for rewards already lined up ahead of time and say, as soon as we open it up, you're going to invest in. That's the reason a lot of people say the only companies, startups that are successful at crowdfunding are the ones that would have gotten funded anyway. And that's how you do it. You raise 50% because as soon as you invite the public and you start getting visibility, eyeballs started coming to your campaign from people who don't know you, they're going to see that it's already funded, and that sends a signal of trust. Well, what did you do? It's all optics and it's all perception. When I did crowdfunding, I've done multiple crowdfunding campaigns and they have been successful. I pound the phones like we're talking to investors, and I make my team raise money every day. And we watch a dashboard. We say, this amount of money came in, this amount of customers came in, and we watch through it. The last 50%-ish typically happens in the last 10 days. It's kind of crazy. So you start raising, and then there's totally this rush that happens at the end of the campaign, and you're creating this FOMO. We only have 10 days left. Here we go. This is the only time you're going to get in on the stock or the product at this rate, and that's what's going to happen. So you got this mad dash, and the best campaigns, take roughly 3 months, but it's usually 60 days is when the action really happens, and that's crowdfunding's a great option. The same is true for government funding, but government funding, you need to already have things loaded up. You need to be credible with the government, and government funding is a great option, but it takes so long. We're talking like 18 months. So don't do government funding as a primary source. Do it as an ongoing thing, knowing that even if they award you, you are going to end up waiting like 18 months. Usually they do their budgets and they say next year, we got you in. And I've talked to founders who have gotten commitments from the government, only have the government change. Somebody comes in office and then they scrap all the plans, or there's a shutdown in the government. There's all these standoffs. It is really tough. So government funding, you don't want to rely on that the same way that you don't want to rely on suddenly crowds coming and investing in your startup, poof, out of thin air. You have to have built-in audience, built-in credibility for you to do crowdfunding and government funding. But it is possible, and I know many founders that have been very, very successful. One of the earliest crowdfunding campaigns that I supported was Pebble. It was like the first smartwatch. It was so good. All they did was release. They're a Y Combinator back company. All they did was release products on Kickstarter. That's all they did. And then I watched WeFunder campaigns do really well, especially if you got big names behind them. So that's how you do crowdfunding is viable. I've got something special. If you're listening to this clip or you've been here, we are going to show you how to use Fundable for your own friends, family, associates. It's a Reg D, allows you to reach out beyond your network to accredited investors. It's not the same as Reg CF completely, but it could give you the taste and allows you to test your campaigns and see if you're even up for something like crowdfunding, because the law, the amount of money that you have to invest to make a successful crowdfunding campaign is significantly high. But what's great, if you're wondering, if you get crowdfunding and let's say you get 1,000 investors that chunk in like $100 a piece and you got $100,000, you can roll them all up in something called a special purpose vehicle, and you can treat them all as one investor. And that's one of the best parts about new laws and the way that you can do it, and tools such as Carta. I think Carta lets you handle it. Angel List, I believe. There are lots of other companies. WeFunder, if you use WeFunder, they basically give you all the tools that you need to do all the legal. That's my DD on crowdfunding. I think I saw a question come in. Jen, we got something?
We sure do. This question is from Hess, asking for early stage investment. Can you explain promissory notes and other alternatives and their benefits? Which is best for founders to not shoot themselves in the foot later down the road? And is there a preferred solution for the founders and the investors?
Perfect. Great question. Thanks very much for asking that. Let's talk about investment vehicles. This is the general rule of thumb. Use whatever the investor is comfortable with, unless you have the power to dictate how those terms go. That's something that founders shoot themselves in the foot way too early in the game. They sabotage themselves because they say, I will only use this instrument. Case in point, the SAFE instrument, Simple Agreement for Future Equity, was created by Y Combinator and now is used by a lot of startups. Back in the day, when I've raised money, and this was even in 2018, 19-ish, and I was raising capital for a venture, the investors that we were talking to, high net worth individuals, had no idea what a SAFE was. I told them, this is SAFE, and they're like, what? I don't get shares? I'm like, no, it gets kicked down the road, etc. And it didn't work, so we ended up just selling equity. There's no such thing as a SAFE in their mind. Even my co-founder was like, I don't get SAFEs, and we fought, and we ended up in a very, very ugly divorce situation. So you have to understand that investors need to feel comfortable, and typically what instrument they're willing to invest in will depend on their sophistication. Real solid pro startup investors, I'm talking gurus, will invest using a SAFE with a valuation cap and nothing else. And I'll explain all the different instruments, but I want to set the context here. Why? They know the game. When I'm writing an angel check, which pretty much I'm going to write an angel check soon, and I'm just going to write it as a SAFE, simple agreement, future equity, give me a valuation cap. Probably not even valuation cap. I like discounts actually, because it really makes the founder push for their valuation in their next negotiation. There are other terms out there, and I'll just say, yep, here it is. No deadline, no interest. Let me know when everything is up and going, and let's sign the safe agreement and let's move on, because we've got better things to do. That's because I'm a founder, I'm an investor, I've been a general partner, I know how these checks get written. I have seen this game over and over again. But another investor may say, I want to do equity because maybe they got rich selling Bitcoin, or they flipped a house, they're your rich aunt and uncle. They're going to say, I need to know I have 10% of your company, et cetera. So you as a founder, you're going to have to work with them. And remember, you can have different investors all use different types of instruments, and that's okay. That's what you can do. So let's go through the instruments that I would recommend. So the first base one, which is least recommended, is selling equity. You give me $100,000. My company is worth $1 million. Therefore, you're going to get 10% of equity. The problem is, how do you know your company is worth $1 million? Like, how are you going to know? You're not going to know whatsoever, right? So what you want to do is you want to kick that valuation conversation down the road and say, we don't need to value my company. Let's value it when we're ready. Therefore, a convertible note or a safe comes next. Downside of equity is that you have to argue over a valuation, and you don't know, and founders, you're not going to know. You are sitting on a hyper growth potential unicorn startup. There are so many factors that go into valuation, you don't know. It's not like you're valuing a Subway franchise or some type of mom and pop shop like a pizza store in New York with reams of data. If you're doing something disruptive, you can't do that. The next thing that you're going to go to, because equity is simple, people do it in their heads and they go, I get it, $100,000, $1 million valuation, I get 10% of the company. Investors are smarter, and if they're simple that way, they're going to want the simplest path. But the next step is something called a convertible. And I'm giving you all the steps because understanding equity, convertibles, and safes will help you go up and down the ladder. You want to think about a convertible as, this is a debt. You are lending me money, and I am going to build this company, and I'm going to convert the money, my debt, into equity later on. Now, what's cool is you've got some options. I've used convertible notes where I've said, I reserve the right to pay you back your money with this amount of interest, and we walk away. I'll pay it back to you by the end of the year, short term. So they basically loan me $100,000. I say that I will pay you 10% interest, 15%, whatever it is, by the end of the year, and it'll keep rolling. And that's what I owe you. Then a convertible note has something called a conversion event. There's an event. And that could be something as simple as you raise $1 million, or you sell the company, or you do a price round, is really what it boils down to. So later on, your $100,000 that I owe you, the clock is ticking, you'll get 10% on your money, and I may reserve the right to just pay you out. I've done convertible notes, and I believe we've done some of these here at Startups.com, where we say we are only going to convert you to equity if we actually take in venture capital funding, something like that. That gives everybody an out, and the interest rate, if it's good enough, then great. So let's say you give 20% interest because you want to reserve the right to buy them out. They could be happy with that. 20% a year, that's an amazing, amazing return on investment. I work really hard to make 20% of my money by trading my capital, et cetera. But returns are usually not that big. Hedge funds, I think, average their return is 14% for the ones that actually make you money back then, right? Most hedge funds, unless you're in the top 1%, lose money and all these things, right? So 10%, good deal. 20%, amazing deal. I'm going to pay you back. But if there's a conversion event and I sell the equity, you get equity, $100,000 of equity at a specific price, and it's all baked into the contracts. Why could this be something that you want to use? One, investors understand. It's kind of like the middle road. They understand timelines, they understand interest, return on investment, and they could be happy with that. And I'm going to tell you a reason that startup investors hate convertibles, okay? They can't stand them because they're not interested in those types of 10%, 20% returns. So remember, it's the type of investor that you are working with. Investors may like convertibles because I understand it, and you may like it because it gives you an out, and you can use that. So if you got something where, listen, you're just going to generate cash flow right away, it's one of these instances where if your company can generate cash flow sooner than later, you may want to get the investors out. Like, let's just get the investors out of here and put that in the contract and say, maybe you can roll it in. I've done deals where I said, you have to take your money out at the end of the year when I pay it all back. You have no choice whatsoever, and we're going to renegotiate. Now, you have to have some serious negotiating power to do that, but I've been in some really high cash flow situations. So now you've got convertible. Now let's move to the next one. Let's move to SAFE. A SAFE is basically a convertible without the timeline, without the deadline, and without the interest rate. And the reason you don't want to do that, you don't want to put a timeline, like put a date on there, is because what happens is startups, who knows how long it's going to take. I've seen founders raise money on a convertible note and they've shot themselves in the foot. They get sabotaged because what happens is the investor says, you owe me $100,000. I'm calling the note at the deadline. A demand letter gets sent in and now you're in breach. If you can't pay that back, you have to go back and negotiate. And you say, all right, well, I don't have the money. And the startup could shut down. The investor could put so much pressure on you that if you don't pay back, there's legal action, et cetera. And a lot of times I've seen startups get shut down because the investor comes back and says, okay, it's been a year. You are not growing fast enough. We're calling the note. And then you got trouble. I've seen a lot of startups, like I said, really put between a rock and a hard place. I've seen Shark Tank investors, Shark Tank, the people that you see on TV, completely hold a startup hostage because of convertibles. So a SAFE is a very friendly way that you can convey information, you can make a decision, and then boom, here's what happens is they say, all right, let me know when you go to the next round, and then we'll deal with the equity there. Because what happens? You put in a note or a SAFE, and it's got no terms other than valuation cap. Let's say the startup is valued at $10 million. The cap is $10 million. And I put in, let's say $1 million. Let's just make round numbers. Now you owe me that money, but we're not going to worry about the valuation, but I'm going to put a valuation cap on it. Now what happens is, let's say at your next round, at the seed round, or let's say you do an A, you are selling at a priced round and you get a valuation of $10 million. Well, my capital gets converted to 10% of the company, $1 million, $10 million valuation. Bob's your uncle. Then you send me my shares and I am now vested. I've converted. But let's say that the next round, your valuation is $5 million. Well, guess what? I get double my equity. It works great for me because I put $1 million, you're $5 million. Now I own 20% of the company. You have to write me the shares if you raise it. So that means you want to push hard for your valuation to skyrocket. But if you go and you get a valuation of $100 million, my million is only 1% of the company. I'm like, that's not cool. I was one of the earliest investors. I should get to the cap. I will still get 10% of the company. Right? And that's where things get a little janky. This is the reason Y Combinator does two safes, puts in money in the beginning and says, okay, we want 7% of your company, etc. And then they do another safe at most favorable nation. This is where the best terms possible, they get to convert their other, whatever it is, $250,000 or whatever they're going to do at the most favorable terms in which you've sold at that moment in time. So you want to make sure as a founder, these are the factors. Let me go back and let me summarize here. You want to think about your investors. What is their sophistication? You want to think about the stage of your startup and when you're going to be generating revenue. And you want to be thinking about what type of investor that you want and when you think your exit is going to be. If you need to go A, B, C round because you're in one of these hyper growth startups that needs capital to grow, then you definitely need to be using safes. That's just what it comes down to. But you may not be so lucky. Beggars can't be choosers, everyone. So you may have to do one deal. I know a founder, the one who did crowdfunding, he ended up raising his first 50K, I think, and he gave like a 50% discount on his first convertible or his first safe. Why? He needed to get that first $50,000, that first pickle out of the jar. You'll always hear me say this expression. So he could go to the other investor and say, I got my first 50K, now let's do it, and pay for his crowdfunding and all those things. That's how you want to figure out what instrument is best for you. And you have to have a balance. There's always tension. One, do I take the money now and potentially shoot myself in the foot in the future and give away all my equity? Remember, founders, when you get to these later stages, an investor is going to make you defend your cap table. They look at your cap table, and if you did some really nice deal, I had founders say, oh, I set aside like 20% of my company for my wife and my kids. I said, do you want to raise money from serious investors? And they're like, yeah. I said, they'll get rid of that. Because an investor is going to say, what are we going to do? We don't have enough cap table to go around. You're going to defend your cap table. That includes co-founders, employees, how generous you are with your options, etc. You're going to have to defend that. So don't shoot yourself in the foot in the short term. Think of it long term and think strategy. Well, at the same time, there's that tension. You might have to do a one-off deal, and investors will understand. An investor will look at the first 50,000 and you say, I have to give a 50% discount because I need to raise that first money. But look at me now. Investors go, okay, I got it. And there are other things investors will do. Later on, when they put in more capital, they may force you to have what are called follow-along rights with your first smaller investors. And they may say, you know what, you have to make sure all these investors in the beginning sign this agreement before I put my $5 million in. A follow-along rights, and there's pro rata, there's all these different things. And an investor, an institutional one may say, when we want to sell, none of your other investors in the beginning can hold us up. They have to agree type thing, and everybody signs. And that's where things get really sticky when it comes to raising capital. Let me end with this. If you are out there raising capital, there are two things that you're thinking about. You're thinking about the funds and the terms. Two things. Pick one. You get to win on one of them, not both. Most founders lose on both, but you get to win on one. You don't get to win on both. Here's what I'm saying. Say you're raising $1 million and the founder comes in and says, I need $1 million. And the investor says, okay, I'll give you that $1 million, but I want my terms. What do you do as a founder? No, you don't get your terms. They're my terms. Well, then I don't need to give you my $1 million. So you're going to lose on the terms. You're going to sign all the terms that you want. Beggars can't be choosers. You're going to sign away control. You're going to sign away board seats. You're going to sign away all sorts of different things, right? Now, let's say you don't need the money and you can dictate terms. Well, guess what? Take less money. And sometimes you can say, listen, I only need 100 grand. And you don't get that much equity ownership and you only get the board seat for the first year or something along those lines. You could do that. But if you want your terms, you're going to get less money. If you want more money, you're going to have to play by the terms. And that's the rock in the hard place, which is the reason you want to build a startup that creates FOMO, generating cash, preferably profitable. That's what you want to do. So you put the power dynamic. I've got a YouTube video coming out on this pretty quickly. It's titled Why Investors Lie to You, or They Lied to You, or The Investors Lied to You. It's going to be a clickbaity title. It's going to be awesome. But you want to make sure that you get the power dynamics on your side so the investors are courting you. Wait. Can you take $5 million? And we'll take less money. Will you do this? Will you do that? And that's where the bidding wars happen. And that's a great place to be. I've been in that spot very, very few times where companies said, don't go and raise money here. We'll give you better terms. And in fact, let's just buy you, right? And that's how I exited one of my startups. That's what we got. That's the great question. Thank you for asking that. Okay, so I'm going to go to another question that typically comes up. How to pivot. Finding new problems at the pre-seed stage. How to pivot. Here's the big problem with pivoting. When you have to pivot, you got to go and basically start from scratch and find a problem. It's very difficult to take your solution and pivot it into a problem that then fits. Sometimes you can do that. And that's where a lot of times I see these stories, like if you watch HBO Silicon Valley, they went from a music recognition app to an algorithm, and they said, here, we're going to pivot. And it was this big thing. They won TechCrunch Disrupt and all that crazy stuff. And I get it, and it's glorious, but it's not reality in terms of it rarely works. And that's the reason that it's a show, right? Silicon Valley is a show. Typically, what happens if founders went and they created a solution and it's not getting product market fit, you have to go through the motion and say, what other problem can our solution solve? And now you're behind the 8 ball. When you should be starting with a problem, I see a problem and I'm going to research how I think I can solve it. If you do that right, there really is no pivoting necessary, because it's just maybe the problem doesn't need to be solved, or maybe there are other factors. You couldn't raise money or the market didn't want that, but you've built something, and that's why I use MVPs to solve that problem. But if you want to pivot after that, you got to take your product and you have to get rid of the problem that you were trying to solve before, say it didn't work. And a pivot could be an iteration. It could be a degree of pivoting and say, we're going to pivot to a new market. So that's how you want to do this. You want to start with your pivot like this. You say, okay, we're pointed this way and it didn't work. And then you want to slowly do it degree by degree. Can we change our target market? Should we change our pricing, our messaging, et cetera? And a full pivot is, do we solve a problem that we weren't even looking at? And we're basically starting from scratch, trying to salvage what we have going on. It rarely works. I have tried over and over again where I made the mistake of creating a solution looking for a problem. It rarely works, but that's how you pivot, in degrees, a little bit at a time, starting with iterations, but eventually getting to a point where does our current solution solve a different problem that we're not seeing? That's how you pivot. Next question. Like I said, if you have questions based on what I'm talking about, let me know and I can answer them for you. How do I get our pre-seed screener deck in front of you? Would love to get your thoughts. All you have to do, that's a simple question. All you have to do, email me at advisor@startups.com or leave a comment on my social medias, contact me on LinkedIn, and we will do a pitch deck review for you. Just a few things here. If you're a member of Startups.com, then your pitch deck review, we do that, and I just send you feedback directly. If you're not a member of Startups.com, well, guess what? Now you're contributing to my content strategy. If you want your pitch deck review, then it has to become a piece of content, and I will review it for you in public. If you don't want your pitch deck to get out there and to be critiqued live on video, and you don't want to become a member of Startups.com, I can't help you, because please empathize with me. I have literally dozens of people contact me every single week saying, can I send you a pitch deck? Can I send you my pitch deck? Can I send you my pitch deck? And this is just how we control the flow, and I prioritize. If you're a member of Startups.com, you got no issues whatsoever. Send me your pitch deck. Next, do I need to be a business guy, someone experienced perhaps, exits, etc., to raise a $2.6 million round? Depends on what stage that you are. We talked about this yesterday with Justin Ford, and I've talked to Y Combinator founders, and it all boils down to this. Justin describes it, you're either a business guy or you're a product guy. Do you need to be a business guy? I would say yes, if you don't have a good product. If you got a good product, you don't have to be a business guy to raise $2.6 million. If you build a great product and it is getting traction, is blowing the doors off everybody, 10% week over week growth, raising $2.6 million is going to be significantly easier. I'm not going to say it's in the bag because they're unit economics. By the way, everyone, I know a great founder, has a great company, and he just eclipsed $4 million revenue run rate a year. Investor said no. Why? Because it's unit economics. The investor could not see how they could 5 to 15x their money. That's the reality. So I'm not going to say it's a slam dunk, but you'll definitely have conversations. I have another company that we're sending out decks for. We're helping them raise. And in the subject line, like they've made $15 million up to this point in time. I've just put, this company's made $50 million right in the subject line. It definitely helps. If you are a business guy and you have a previous exit, you've got domain expertise, you're a Nobel Prize winner, you came out of a big company, you helped the company go public, you're a founding team of some big, huge, technological dream, a disruptor. Let's say you're like hire number 2 at Airbnb, and now you're solving problems that Airbnb is ignoring, and you see a whole other different market. Yeah, people will give you money just because of your pedigree. It does happen. I've seen it. Case in point, Adam Neumann, okay? Adam Neumann, he's a nobody, goes and convinces people that co-working is going to be massive. We're going to build a platform for co-working. We're a technology company when it's really just office space. But he starts WeWork, and he raises huge amounts of money. I forget how much money he raised. I think $1.3 billion from, don't quote me on that. I was watching the show the other day, and I can't remember the numbers. And then the whole startup tanks, and basically WeWork files to go public. People start seeing, they're like, this isn't a technology company. It's a real estate company. All the unit economics are way off, etc. And then guess what happens? He does the amazing thing, and he makes them get him out of the company, and he basically leaves like a billionaire or something like that. It's just crazy insane. Well, guess what? He's got all this domain expertise, was able to raise money, and now he's got this other venture that is in the same domain of living spaces, etc. And people are throwing money at him. Biggest game in town, A16Z, one of the biggest, I think second to Sequoia. Invest in this guy. Why? Because how many founders go out and raise billions of dollars and can actually get WeWork to the place where it was a tour de force, it was recognizable. How many founders are going to do that? Of course, you're going to bet on that. If Jeff Bezos came to me tomorrow and he said, Ed, I'm doing another startup and I don't know what it is. Will you invest in me? I'd be like, take my money. Take my money. Let me know what it is, because you're a business guy. You've done it before. You know what it's like. So you're going to be one of the two. I'm not that guy. I'm not Jeff Bezos. I have pretty good reputation with investors because I have been able to give a return. I've exited out of 2 companies, but even then I still need traction. I can't just walk into a VC and say, stroke me a $2.6 million check, right? I'm not there yet, and I doubt I'll ever be there. I'm too old, too tired, and focusing on other things. But if you are, well, then go for it and do that. The alternative is build a great company and show investors traction. That's how you have to raise. Traction is the name of the game. Traction, let's just put it this way, traction on a path to profitability. That is how you raise $2.6 million easily in relation to what everybody else has to go through. I wanted to know, when you start a fully bootstrapped startup, how do you manage expenses like personal expenses, business expenses? That will help me out. All right, here's what you do. It's called an LLC, everyone. It's called take care of your corporate taxes and use the tax world to your advantage. Don't start a corporation. Do not start a corporation. And there are so many ways that you can pretty much take care of your taxes and start to do business and get write-offs without a corporation. A corporation is an entity unto itself. It costs thousands of dollars in paperwork, annual reports, shareholder resolutions. It is just a nightmare to deal with. You have to have board members, all those things. And it's a nightmare to change if you want to add more shares, etc. So when you're bootstrapping a company, the word bootstrapping implies that you don't have millions of dollars in your war chest, dry powder to live off of. What are you going to do? You're going to reduce your burn as much as possible. You're going to form an LLC, which I form LLCs all the time. I work out of Texas. I live in Canada, but all my partners and my funding is down there. So we got companies in Texas, California, different places. I don't like Delaware. I don't know. I just don't see the advantage of it. Texas to me, or Nevada is another place, because I've got my partners down there that can do my banking, etc. I form an LLC and gives me a limited liability and partnership. I don't have to have all these agreements. It's super simple. Cost me $75. A bookkeeper can handle everything. We can file our own taxes. And I just run the business out of there. If I want to raise money, I'll either raise to the LLC or I'll tell the investors, if you write me a check, first thing I'll do is I will form the corporation and we'll deposit it in there, and Bob's your uncle. That's how I'm going to do it. But in the meantime, if I'm bootstrapping, because I don't have all those discretionary funds, I don't got that runway, I'm going to track all my expenses related to the startup, okay? All my Google Drive, my Dropbox memberships, all the different apps that I buy, research, and I'm going to put them in the company and I'm going to write them off. I'm going to take advantage of that because an LLC allows you to do that. Now, you don't get the huge tax write-offs because a loss is the same way, completely different. You can't pull an Amazon or you can't pull a Google in terms of all the write-downs, et cetera. Elon Musk, that's what he did. You know why Twitter lost a bunch of money? So he could have huge write-offs. Like, it was a genius maneuver. He doesn't have to make money in Twitter. Like, this is the richest guy in the world, right? You can't do that, but at least it'll help you keep your expenses, get a simple program, apps, QuickBooks, everything like that, and run all your stuff, your cell phone, you name it, right through the company, and then you write it off against your taxes and any money that you make, and you're good to go. That's how you bootstrap and make sure that you keep your burn low. Good question. When to quit your job? When do you quit your job? Let's go into this world here where you're bootstrapping away. When you quit your job is a very, very personal question. If you are trying to build a startup as a side hustle, when do you quit your job? Well, here's what you do. You have to analyze how much your burn rate is, your cost of opportunity, and factor all that in there, plus your lifestyle, all those things, and come up with a number. I think it's called the true rate or something like that. I don't know. There's some scientific term out there, but I say cost of opportunity. So here's how I determine whether I'm going to quit my full-time job. One, my startup has to be generating revenue, right? Then I have to do an analysis on how much money do I have in the bank, dry powder. And then I have to go, how much are my expenses? I have a mortgage. I've got kids. My wife doesn't work. I'm the sole breadwinner. My kids are going to college right now. They cost a lot of money. They're going to stay at home for as long as possible. All that stuff gets factored in. Then I look and I say, what is my lifestyle? My wife isn't going to love me anymore if I force her to eat ramen noodles. If I was living in my parents' place and I was back and I was 20 some odd years old, and I lived in my parents' place for a little bit, and I was just making money hand over fist working in startups, and I was paying like $300 rent. I didn't pay utilities, anything like that. I was banking cash. I could take a whole bunch of risks, and I didn't have to work. But then there came a time where, guess what? I need to start to work, and I was paying rent, and I was married. I got a part-time job, right? So when do you quit? You have to factor that all in, and you have to say, what am I comfortable with? You might have to have 6 months of expenses in the bank, plus your salary saved up. That's the reason they do this in franchise. They say you have to have 6 months or a year's worth of wages saved up before you actually go and open this franchise. You have to make that decision. And you have to know, how confident are you in terms of, if you quit, can you start making money? Therefore, the whole concept of, I'm just going to quit because I have to make money, that only works, that all-in moment, if you've got nothing else, and you have your limited amount of burn and you can afford it. There are times where, when I went to China and I got seed investment from China, it was actually more like pre-seed. It's like a bridge, pre-seed bridge. Went to China and I didn't know how I was going to pay rent. It was my all-in moment. It was do or die because I had no other choice. I had to go to China to try and open up the market and secure that investment. I do not advise that. I still have the mental anguish and I still pay for therapy for my time in China. You know, it was really rough, back then. So when you quit, that's a personal decision, but do it with data and do it with projections and do it using wisdom and go from there. All right, next, we got time for a few more questions. If you got any questions, make sure you throw those into the chat. I am happy to answer questions from the audience first rather than drone through all the questions that I've got in my social media comments. Let's take a look at the next question. What's up with the GGGs? The G's in the background. If you see the GGG, up here, I think I'm pointing it to the right way. That's a secret. It's embedded in all my YouTube videos here and there. Watch my YouTube channel. I'll answer that there. Next, a VC goes through so many pitch deck companies, and I'll select a few. There's maybe 2 unicorns. It's not even that. All right. Not even that. My question is, what is the underlying reasons why invested startups fail? At the very core, what would you say are the top 5 reasons? Okay, so let's talk about the reality if you're showing investors. Out of the funded companies, 1 to 2% of those companies will become unicorns, right? Most of them will lose money. Like 10% will succeed, 90% will fail out of the funded companies. So if you're a VC and you get 300 pitch decks sent to you, you might, let's just, for the sake of numbers, you might be interested in 30 of them. So 270 are going to go out. And then out of the 30 of them, you might invest in 3 of them, right? 6 or 9 of them. And then out of that, 1 of them will go unicorn. So the numbers are staggeringly small for the number of founders that are raising capital. Yet, VCs complain that there's not enough good startups out there. There's not places to put the capital. It's because it's so much easier to build a startup and there's just a glut of competition. The question, what is the underlying reason or reasons why invested startups fail? Okay, so first, you get your investment. Why would that investment fail? It boils down to one thing alone, product market fit. That's it, product market fit. And there are many factors that boil down to it. Timing of the market is probably the biggest one. The inability for the founders to pivot enough to figure out product market fit, or they break up, they lose momentum, they start hating each other, they run out of money, they make some bad decisions, but they don't get to product market fit. So it's just really one reason alone that startups fail from a start perspective. Many startups will go on to be successful businesses, small businesses, right? They'll be successful that way, but they won't go on to be unicorn startups. So I'm talking about any company that doesn't go unicorn is considered a failure, because of one reason, product market fit. And below that reason is a tree of all the different things. Co-founders that fight, can't figure out, market trends change, the timing is just not there, competition comes and eats your lunch. I know lots of companies, timing is a big thing. You know how many companies actually had the idea to do Facebook before Facebook, right? They had this great idea, but Facebook came at a really great time. But not only that, they had a really great strategy. Let's do Stanford. They had Mark Zuckerberg. They had the right angel investor, right there. Do you know how many companies have thought about doing YouTube? I was actually approached by a company that wanted to put cartoons on the internet, and they made me a deal, and they offered to buy into my startup. Back then I was doing an animation company, and take my product. And my startup was already bought. So I was working for the company that acquired me, and we said no because I'm like, I don't see if that's going to happen. In hindsight, should I have said yes? No, because all the companies that went and did that deal, and they signed that deal for back end and all that stuff, none of their animated properties exist anymore. And I'm going to give you a little secret. You know who was behind that deal? The company that did The Simpsons, right? They were trying to get an online streaming. They're not in that business anymore. Later on, YouTube comes along and eats their lunch, right? So that's how this works. So you want to make sure that you're going for product market fit, but understand there's so many other factors that go into it, and that's what makes startups significantly hard. That's the reason startups fail. One reason, they fail to get to unicorn because of product market fit. Moving along, I'm making good time. How much is spent by the target market? Municipal construction is huge. Spending area and your presumed savings are a percentage of the total spend. I think this boils down to this founder is asking how to calculate market size in something like municipal construction. Let me give you just an example of how to calculate market size. There are 3 ways, and I harp on this all the time. There's top down, which is what this founder is referencing. Spending across all municipal construction is $3 trillion. Okay, that's top down. That's all spending. That's not your market. So you might not want to use that number. But let's just say that your target market as dentists and helping all dentists manage their money. You can say all the dentists in the world make $3 billion a year. Okay, that's a top down. That might work when you're presenting. But there's a common word that I want all of you founders to learn and get grilled into your mind when you are doing your market sizing. The word, wait for it, extrapolation, i.e. learn to extrapolate. Now, you don't have to do it all yourself. I do this with ChatGPT. I say, ChatGPT, extrapolate based on this, that, etc., and how many people, and ChatGPT AI will do extrapolations for you. But those extrapolations have to make sense. That means you go bottom up and you extrapolate what the potential market is. So let's say that your solution is in municipal construction, but it's in project planning. You extrapolate in saying that there are 3,000 municipal planners that do project planning, and they have this many employees times what I think I'm going to make. I now extrapolated my market. We could be a $1 billion company, right? If we handled everybody. Now, these numbers are pie in the sky. I'm throwing everything out there for you. That is bottom-up analysis. You just calculate and you tell your investor, listen, I have calculated and I've gone and done the research, and I think this is the number of users that we got. It's a big number times what I'm going to make. That's your bottom-up analysis. There's one other technique. I'll get to this question in a moment. One of the techniques is called value theory, and I've used this before. Let's say your company solves a problem that is a $1 billion problem. $1 billion problem, and you say, guess what? We are then going to save that company $1 billion. And to save them, our theory is it'll be worth 10%. They'll pay us $100 million to solve a $1 billion problem, or the whole market. And that's what we're going to charge. Value theory says your market is worth $100 million. You see how it works? Now you can use a top down and say companies lose $1 billion in this problem. That's top down. But our value theory is if we save the amount of money and we can charge that, that's just one example of value theory. It's coming with a theory of what your startup could be worth and how much money that you will make. That is a bottom-up analysis using value-based theory. That is a great way to do it as well. And investors really like that because why? Wait for it. You've extrapolated. And that's the type of mental exercise, mental acuity that founders can present to investors. Investors appreciate. That's how you do this. Hopefully that answered your question. Jen, we got a question.
We do. The question asks, how does one introduce themselves to investors and give a good first impression at a tech event?
First of all, don't go to tech event. Just letting you know. You're not even going to meet the investor. Real investors don't go to tech events. Why? Because they're just going to be inundated by people. All right? So that's just the reality. But let me break this question into two parts. One, how do you make a great impression on an investor if you happen to run into one on the street? Second is, how do you make a great impression at a tech event so you meet investors? I think that'll be a better way to answer that question. Jen, correct me if I'm wrong, if I'm going down the wrong way. Okay, here we go. So when you meet an investor, first of all, what you do is you just find out about them and their background, and you talk to them and you ask them about them. Do you know how many people I've had amazing interactions where I've met someone at a conference and I find out they're an investor or subject matter expert, they're a power player in some form or another, and they end up inviting me to their home. Why? I don't immediately hit them with my resume and ask them for stuff. I ask them a lot of questions. I use my emotional intelligence, use my empathy, and I try and make the conversation interesting, and I find out. Then, if they happen to be an investor, I'll ask them about their investment thesis, how's it going, etc. And then I will ask if it's appropriate or not to tell them about what I've got going on. After I've talked and I've shared how thoughtful, how much of an expert I am, I want to be the most interesting guy in the room, okay? Who's that guy, the most interesting man in the world in those commercials? You know, I don't always drink beer, but when I do, I drink, I think it's Dos Equis or something like that, right? You want to be the most interesting person in the world. Even if that investor doesn't invest in your space, you want to have that gleam in your eye, that little sparkle and shimmer that you know something that everybody else doesn't, that you're in on a secret that nobody else knows. And that means you have to be a formidable founder and you have to know your stuff. And you have to kind of leak it out there and talk. Investors are going to be okay because that's their job. They're going to be okay with you saying, hey, do you mind if I share an opportunity? I'd love to get your feedback. But you don't go out and ask them at the event, will you invest in my company? You say, I'd love to present to you. When would be a great time? I can do it right now in 30 seconds if you want. I want to be appropriate. Let me know. And you pique their interest and you say, I'd love your feedback, even if you don't invest in that space. I'd love to just get to know you better, and I'd love to ask you questions. Investors love answering questions because they think they're experts. Just like I love answering questions because I'm obnoxious and I think I'm an expert. I just happen to have a lot of questions, thrown at me. But guess what? Wealthy people, investors, love helping other people because they know what it's like to have to go through everything on their side. So billionaires, I've met billionaires and they are some of the easiest people to talk to. They're some of the most friendliest people, and I just pepper them with questions and they love answering them. That's how you impress an investor. Now, how do you impress a contact at a tech event that might introduce you to investors? It's the same thing, but there's a slight catch. You want to figure out how you are going to make that person look good. So you got to figure out what's in it for them. What's in it for them to introduce? For example, this is where founders really mess it up. But do you all realize, founders, that I would be happy to talk about you with investors if you help make Startups.com look good? Startups.com looks better when I introduce you to investors out of the Startups.com program. They love it. In fact, I have raised significant amounts of money because I know lots of founders and I share great stories, and I've raised money for funds for startups, right? Because they run around and they go, oh, wow, you've got access to a lot of deal flow. And I make them look good. I say, what's in it for you? How can I help you? And so I've had people come to me and they've said, Ed, could you speak at my event? I go, great. I will do that for you. They asked me, we just got an invitation. Jen can confirm this. We got an invitation for local incubator and a government program that invests in startups and helps everything. Why? Because I will make them look good, right? And so they're going to network me. So you have to figure out what's in it for them, and you have to be generous, which happens to be one of the G's up here. One of the G's here stands for generous. You have to be generous, and you have to help them look really good. That's how you get networked at tech events and you get referrals. So hopefully that's your question. I will answer more in the future. I think that's it, Jen. That's it. You're giving me the nod. All right. Thanks, everyone. We didn't have our guest today. We'll make sure we'll hunt him down, and I will make him feel totally guilty, and we'll get him on the show later on. We are here every Tuesday, Wednesday, and Thursday. Make sure you check your Startups.com calendar. If you're joining us on the interwebs anywhere on YouTube, do the YouTube thing, like, comment, subscribe. Always helpful. We're here for you. Thanks, everyone, for hanging out. Thanks, Jen, as always. We'll see you in the next show.